welcome everybody. Thanks for forgoing Russia against Saudi Arabia in favour of renewable power project risk. Hopefully it will be more entertaining than that. My name's John Massey. Just for a very brief introduction to myself to kind of justify why I'm here. I've spent just over 25 years now as a kind of industry market and business analyst. 15 years of those have been as an independent. And these days my focus really is on renewable power and moving towards renewable power, which includes things that are going to help integrate that as well. So I also look at energy storage, electric vehicle infrastructure and other associated things on top of that. One of the things I do is present the Renewable Energy Mini MBA for Green Power Academy, as well as various other training courses and some coaching and consulting as well. So that's kind of why I'm here. Obviously part of the rationale for this webinar is hopefully to give you some useful information as it stands, but also to give you a kind of flavour of the sorts of things that we cover over a much longer period, 5 days of the Renewable Energy Mini MBA. Okay, so heading straight into it. We'll start, the title is obviously quite ambitious. There are lots of variables, there are lots of things that affect risk when you're thinking about a renewable power project, either as a developer or as an investor in particular. We'll have a quick look in a few slides time at particularly the kind of finance side of it, stuff over here. We tend to obviously think a lot about return on investment. We're putting lots of money into these things. How quickly will we get it back, and how much will we get back, and what are the risks to that? What might go wrong? But I think, and one of the things I always try and stress to people is that when we're looking at project risk, and actually beyond just projects, the whole renewable power risk, we do need to think beyond just the finances of it. There are lots of things that feed into whether we can make a return before we even get there. And I've listed some of those here. Is it what I've called politically and socially acceptable? So is it part of a strategy and a policy around clean energy, for example? But what about the cost of energy? Does it require subsidies? Are those subsidies acceptable? Are they sustainable? Are they just planned for a short period of time, or are they going to go on and add to people's bills for a long period of time? And linked to that are things around land use, visual impact and so on. And those will be amongst issues which will also feed into the one over here, which I've called is the project deliverable. So you might have a fantastic business plan that makes great financial sense, is going to make you rich, but if you can't find the land to put it on, or if you've got a patch of land and you're tied in with local protests for months, or if you can't manage to come up with a reasonable environmental impact assessment, or there are local planning rules, or you can't get the staff. I mean, there's a whole bunch of reasons why you might have a good business plan on an Excel spreadsheet, but it's not deliverable on the ground. So again, that all feeds into overall risk. And then the other two are to do with integration. I mentioned that in my intro as to what I also spend my time thinking about. And that really is the impact on the rest of the market, particularly as we get to a stage where renewables are starting to be, in many cases, the cheapest option, and so subsidies aren't really an issue. What can become an issue, and what should be an issue really, is the extent to which renewables fit into both the market operations, the way the energy market works, and also the energy system. And so if we're talking about power projects, what that essentially means is the grid. So it will have an impact on other power plants. It will have an impact on, for example, grid congestion in some cases. So there are various issues around actually, can we build the project? Is it going to have a knock-on impact elsewhere? And those knock-on impacts elsewhere can create cost. So if our business plan looks fantastic, but we're just pushing on cost to a grid operator, which eventually then finds its way back to the customer. Again, you can see how some of these big areas of risk start to link together. So that's a kind of a first general picture, and I think it's always useful when you're thinking about renewable power and project risk to be prepared to take a step back. It's very easy to kind of dive straight into a spreadsheet and start saying, right, okay, how much money will we make and where might that go wrong? But certainly from a business sustainability point of view, you also need to start to think about some of these other things. And in particular, bear in mind that some of these other things may well change. So the political environment, the policy environment can change. Certainly the impact on the system, the workings of the market can change. Planning policy can change, public perception can change. There's all sorts of things that in the duration of your project may be different now than when you started. So that's the kind of big picture view, and I think it's always worth having that in mind. Now, when we step onto a project perspective, again, it's worth having a step back and thinking about the project not just as a construction project. So how do we sort of raise enough money to build it and then operate it and make lots of cash? But what other processes and what stages go into producing that project? And again, this is just a very broad overview. I split it into three bits. So I've defined what I've called the development phase, which I'm calling that all the things you do to the point where you arrive at this thing, final investment decision. You might, again, there's just some acronyms here for you that you might come across. So FID, final investment decision. So in other words, there's a whole bunch of stuff you do where you get to a point where you've got your spreadsheets and your various other documents, and you can go to your investors, could be your equity investors, it could be the bank, and you can raise enough money. And once you've raised enough money, then you can start building it. So we've got a construction phase. Once you've built it and tested it, at some point you reach commercial operation date, and then we're into operating the project. And clearly from a timescale point of view, we would hope that the operational bit of this is going to be much longer than the development and construction phases. And I'll come back to time frame because that also is an important element of risk. Now, generally speaking, the further down this chart we go, the lower some of the risks should be. So at the top in the development phase, of course, the risks here are, and I've just listed one or two of them, the risks here are that you don't have a project in the first place. So if you do your resource assessment and find, well, it's just not sunny enough, or it's just not windy enough, if you can't get a permit, if you can't get planning permission, if you can't sign a PPA, or you can't sign, there's a whole bunch of other contracts, legal documents that you need to be able to sign. It could be PPAs, it could be EPC agreements, it could be supplier agreements. There's a whole bunch of stuff that you need to have in place to be able to raise enough money, and maybe you can't get access to enough money to actually come to this investment decision. And if none of it, if all of those don't come together, the risk is very high. You don't have a project at all. And it's still the case. You'll hear various figures depending on how people define when a project has started. But the majority of projects which people start thinking about, start doing some development work on, will not come to be constructed. So a company might, for example, start looking at 5 different projects on a desk-based basis, just doing some very initial scoping out, and it may only be that one of those ever actually goes through to construction and operation phase. So high risk, but you're not ideally spending a lot of money in the development phase. So most of this is not expensive as in shelling out lots of cash, but it can be time consuming. The development phase can be very long, especially for very big projects, and often that's one of the areas I think is often underestimated by people, is how long development can take. Now, I was going to approach the discussion today in large part on the basis of renewable projects, which is currently the case, are often looking at entering auctions. They're looking at, and so that's what I've called a market entry point. Your way of entering the market is that you're going to win a bid. You're going to bid into an auction and you're going to win a nice long-term PPA with the, or feed-in tariff, whatever you want to call it, with the government. It could also be that you're entering into a tender with a utility, or even trying to win a bid with a corporate client. But generally speaking, you're looking at, you've got to have some kind of market entry point, and often they are time limited. So it's no, so there's also a balance here. I mean, if you're going to spend so long doing various development stuff that you miss the date for the next auction, then there's a risk involved with that as well, because by the time you have to wait for another round of bids, the business situation may be very different. The bids may be much lower. You may be looking at generating a lot less revenue if you miss a deadline. So again, one of the things when you're thinking about risk is to look at how different risks come together, but also looking at risks over time. So time frame becomes quite an important kind of variable to look at in the context of risk. Okay, so if you can do a reasonable chunk of work here, well, you do a lot of work here, but the more work you do here in general, once you've got a project, if you're more diligent here, you can reduce your risks down here. So if you design a better project, chances are it's going to work more efficiently and be more available. If you design a project badly by cutting corners because you're rushing to get into an auction or a tender, then what you might find is that you end up with less energy than you thought you were going to have. You might also end up with less energy than you thought you were going to have, simply because we're talking about nature. If we're talking about solar or wind, we're talking about a weather-related risk as well. So again, these phases, although I've separated them by different steps, they do link together when we're thinking about risk. So generally speaking, development can be quite long if you've got a very big project. Construction these days, if we're certainly talking about solar or we're talking about wind, it's amazing how quickly very large projects can actually be rolled out these days. That's one of the things that's contributed to lower costs. We've just got better at building these things quickly, efficiently, in a very kind of automated fashion. So the risks in the construction phase are largely that it's going to cost you more than you thought it was. So you might have, that might be around actual cost increases of equipment. It might be around just time delays, which accrue costs as well. Now, generally speaking, one of the things you can do against that, of course, is you can mitigate that by tying it all up into an EPC contract where you pass the risk onto somebody else. So again, that's part of your work in the development phase on your contracts. There can be some other risks you need to think about in construction. If it's delayed too much, your permit might expire. In many bidding systems also, your commercial operation date has obviously there's a time limit on it. The government doesn't want to award you a contract and promise you a revenue stream and then have you dither about for years sort of before you get building it. So there might be some, if your permit expires, then that obviously is a very large risk. You may not be back to an issue of no project, but you're probably back into here. You're probably going to having to renegotiate a whole bunch of stuff, from PPAs to financing deals to potentially permits and so on and so on. And then once you get into the operational phase, really the operational phase, if you've done everything correct prior to that, you should have built a project which you can predict quite well how it's going to perform. You can predict quite well how much it's going to cost to run. You've hopefully got a relatively long power purchase agreement which gives you security on price. And And so the risks there are that maybe you've got that wrong, maybe it does break down more than you thought, maybe it does cost more to repair than you thought. If you've not got a very long PPA, or in some cases now you do see projects where they're just entering the market on a merchant basis, they're taking market price, then obviously one of the risks is that the sale price might be lower. Whenever we talk about risk, of course, it's also worth bearing in mind that the flip side of risk is potentially opportunity. So a reason why people might choose to just sell on the open market is that actually there might be an upside. You might find that the price of electricity actually goes up, and so you can sell it for more than you had in your original plan, which would be nice. Obviously, policy risk of regulatory change is a big one going forwards as well. But really at the operational phase, the biggest risk should be not that your project is suddenly going to be stopped or fall to bits, but that maybe you'll make a bit less money than you thought you were going to. Okay, so again, we've had a general sort of market view of risk, general project view of risk. The other kind of generality of risk is to think about where they come from. And in particular, I think it's worth thinking about kind of two divisions here, which I've split into what I've called internal and external risk. And what I mean by that is I'm thinking about internal risk in terms of what I've called factors you can control. You'll notice I've got a discussion point at the bottom where it's worth thinking about whether you agree with what I've defined as things you can control and things that you can't. By things that you can control, what I'm saying by things like customer choice, how much electricity you generate, PPA price and terms. Now, clearly it's not just down to you what the PPA price is going to be. You've got to negotiate that with somebody, or you've got to win a bid against other companies. What I mean by that is that it's up to you whether you accept that. There's no one kind of forcing you to take a particular price. There's no one forcing you to enter a particular market or with a particular customer. You should be able to control things your costs as well. I mean, that's again down to your planning and your contracting and so on. Your financing costs, which we'll come back to a bit later on. So there are things there that you should be able to control, and if you don't like them, you don't have to do the project. The same with once you're running the project. Again, your operating costs, the reliability and performance of your project are things that really it's down to you to have some control over, because you should have planned for that in the first place. Your design should be reliable, your low cost to run should perform well. So there's no one from outside coming in and changing your risk on that. You might be taking a higher risk if you've not done as much work in the design phase. Now you notice I've got some of these things in green and some of them in black. Again, very broadly speaking, the ones in green are ones that I'm looking at as having a more of a forward risk. So most of these ones, the ones in black, are things that you're kind of deciding and you can control really before you even start operating the project. The ones in green are things that there's still scope for them to change in future. So again, we're into timescale here. There's some risks that you can kind of rationalize and set in stone now, or get past now, but there's always going to be some risks going forwards. And particularly going forwards, you'll notice all the stuff on the right, which I've done under external, as I've put into that future category. And so by external risks, the kind of things I'm talking about are, well, what happens if the policy environment changes? Now, that's policy risk is quite a big point of discussion, a big point of analysis when people are looking at projects in different parts of the world. There's obviously very little you can do to say that, to guarantee that in 5-10 years time the policy environment, the politicians might decide to move the goalposts. But you can certainly look at things like legal frameworks. If you've got a PPA with a government that's supposed to run for 15 or 20 years, how reliable is that, the legal framework in that country? So if they do decide to try and move the goalposts, have you got recourse to go and take them to court and get compensation and so on? You can look at kind of past history and so on. There are other what I've called business environment changes, which might include things like tax rules, which it's perfectly legitimate for governments to change. Certainly here in the UK, the government does tweaks around with tax rules every year. So there's changing the tax environment is something that governments can do on an ongoing basis. I mean, that's not something that you can really, you can sort of have a sense of direction. You might be fairly confident that they're not suddenly going to kind of double taxes, but there's certainly things that can change. The market, it is changing. The market in many countries is changing reasonably rapidly, both in terms of demand for electricity, but also supply of it. That will affect, that balance of supply and demand will affect the value of the electricity you're trying to sell, the prices, in other words. You don't necessarily have much control over things like how much your staff want to be paid. I mean, that could certainly knock onto your operating costs if suddenly there's a huge competition for staff and you start having to pay them more to retain them. Again, rules, planning rules, permitting rules and so on, that shouldn't be a big deal for your current part of the project, but you might want to expand the project. Here in Europe, there's quite a lot of wind power projects in particular, which are coming really to the stage where companies want to do what they call repower projects. So they've got what at the time was state-of-the-art wind turbines, which are about kind of half a kilowatt, which they'd really want to go and put 2, 3, 4 megawatt turbines on the same wind farm to produce much more energy. But again, they may not be able to do that because of planning rules. And again, various other things, public opinion, financial markets, and obviously the weather, climate change. If over the 20-year period of your project, is the solar resource or the wind resource, is there potential for that to change either? Again, and some of these can be risks, but some of them could be risks with an upside. There could be opportunities. So again, it's just a kind of a checklist, if you like, of a whole bunch of things that are worth thinking about. Ultimately, all these things you can feed in to your financial analysis, but I think it's worth making clear at the start that risk is not just about spreadsheet and numbers and so on. I guess as another general point to make is that as we move more towards a world where renewables are not requiring subsidy, or potentially moving into more of a kind of market-based environment, or having to negotiate either shorter PPAs or PPAs on a much more competitive basis, I'd say that in general, a lot of the internal risks, particularly around technology risk and building projects that work reliably and operate efficiently, a lot of that is fairly minor now, unless you're using some new technology that's a new type of panel, some new type of tracker or whatever, new type of wind turbine. A lot of that technology risk is regarded as relatively small. It's well known, it's well understood, got lots of these things operating. Whereas in the past, they were kind of key risks which would raise the cost of finance or make financing in some cases harder to get. So in general, I think there's been a shift more to those external risks. So people are starting to think a bit more about, okay, well, I know how to build a project. I've built a gazillion solar farms or wind farms in various parts of the world before, but if I'm moving into this new market, all that kind of stuff I know how to do, but where I'm uncertain, where I'm looking a bit more closely at risk, is things like the policy environment or the business environment or what's happening in the wider market and so on. Those are, so in general terms, external risks, I think people are wisely spending a bit more time thinking about these days than perhaps they did in the past. Okay, so having said it's not all about the money, let's at least spend a bit of time now focusing on the money. So this is a very simple view of kind of the economics of a power project. It doesn't just have to be a renewable power project, but any power project. Clearly, to make money, you've got to generate more in revenues than you spend. So your revenue's got to be greater than your costs, and that's got to be true over the duration of the project. So not just, we've got a bunch of costs which is now to build this stuff, but actually most of the rest of our business model is taking place in the future. So our operations and maintenance, if we've got fuel, which could be biomass, so it could be a renewable power project, but equally you could model gas and so on with this, or paying back our investors, paying the government its tax and so on and so on. Those are all future costs, and also the revenue that we generate is in the future. So again, timescale is going to be important. And for most power projects, what we're interested in terms of revenue is how much energy we generate and what we can sell it for. Now again, it's worth making the point that going forwards, there may be other revenues that are relevant. In some markets, for example, either carbon credits or renewable energy credits, certificates, whatever term they're given, there may be some emissions benefit, which also emissions reduction benefit, which is giving you some other revenue on top of energy. And again, going forwards in future, you'll start to see power projects also potentially making money out of what I call capacity payments. So being able, around their reliability, being available at peak times, for example. That potentially is one driver for adding storage to renewable power projects. And along with that is the ability potentially to offer other grid services like frequency response and so on. But certainly for the time being and in the main, renewable power projects, where we're making our money is by generating an amount of energy and selling it for a certain price. And as I said earlier on, from a risk point of view, the way I was going to look at this briefly today is to imagine that we're really looking at situations where we want to try and minimize our price because to enter the market, we're probably involved in some kind of competitive bid. So if we can get that price competitive with whoever else is bidding, then that's great. And so the kind of variables we're going to play with are going to be less about price. Price will be more of an outcome. The variables we want to play with are more about, okay, how much energy can we generate? And I'll come to capacity factor in a moment as a way to kind of visualize that. And then how much it costs us to generate that energy, both in terms of our upfront costs, our capex, and also our operations and maintenance costs, the cost to run the thing. And then also the other thing I want to kind of impress on you throughout this is how different factors are interconnected. So when we're talking about variables, they're not really going to be independent variables. It's not that you can change one thing without having an effect on something else. And so another part of risk analysis is going to be to understand how, if you do change one thing, what impact it has on other variables and hence on the outcome that you're trying to produce. Okay, so capacity factor. Now, I think capacity factor is quite a useful, I like it as a metric because it connects energy with money, essentially. It doesn't look like it from that definition of capacity factor because obviously there's no money on there. But bear in mind that capacity is what you pay for. So capacity factor, I mean, as defined here, capacity factor is basically comparing the actual amount of energy you generate from a power plant over a defined period of time, usually a year. It's dividing that by what you could generate from your power plant if it ran at full capacity for the entire time period. And the connection with money, therefore, is that, remember, you pay for capacity. So capacity has cost you money. If you're not getting your maximum energy generation out of that capacity, then in effect, you're not getting the full potential out of each dollar you spent on building that capacity in the first place. And so a higher capacity factor, so more energy for the same investment in capacity, is going to generate you more revenue for the same investment in capacity. Or in the case of a competitive bid, it means that you can charge less for that energy to make the same amount of revenue. So capacity factor, so basically high capacity factor is going to be good if we're in a competitive situation, because it means that if my competitor is spending the same amount of money to build the same amount of capacity, but I'm generating more energy from it, I can either charge the same as them and make more money, or in a competitive situation, I can make the same money by charging less than them, and hence winning the bid and getting into the market in the first place. So I like it as a metric, not because of the energy capacity link, but by linking your capacity with having spent some money in the first place. So in my mind, capacity factor is a good linkage between investment and energy that you generate. Now, to link our energy generation with our costs, as on the previous slide, there are obviously various reasons why our actual energy generated might be less than the amount we could generate if we operated at full capacity every hour of the period that we're measuring, so every hour of the year. And you can split those into two main ones. One would be that we're not operating for every hour of the year, so we're not operating for the whole time. And the other one would be that when we are operating, we're not always operating at our full capacity. So if we take the one on the right first, operating at below capacity, that's going to happen, assuming that it's not related to lack of demand, and certainly with renewable power that would rarely be the case, because renewable power projects generally get first what they call priority dispatch into the market. So if we can produce, we're normally able to sell our power, but that's really related to resource availability. Our capacity, if we think about a solar farm, our capacity is based on maximum solar resource. So noontime on a sunny day is when we will produce potentially the maximum output of our power plant, the rated capacity of our power plant. Early in the morning, late in the evening, the sun may be out, but the resource is much smaller, so we'll be operating way below capacity. So that's to do with resource availability, which for renewables like solar and wind is to do with nature. So inherently there's a risk. One risk to our energy generation and our capacity factor is nature, is the availability of our resource. And obviously there's an amount of work we can do that. A key part of our project development is our resource assessment. So looking back at kind of historical weather data, and also then projecting that into the future, is going to give us a good, at least a kind of averaged idea of what our resource availability should be. But there will be uncertainty around that, and that certainly has some impact on risk and on the potential outcomes of the project, which I'll come back to a little bit later on. And then on the other side, there is the issue of not operating when we could be operating. So we might have resource available, but we're just not able to operate. And that's really to do with what I've called plant availability. So it's not the availability of primary energy, it's the availability of the plant to operate. Is it working or not? And that really is then obviously down to project design and reliability. And so some of those costs that we've spent here to build our capacity are also relevant up here, of course. So that's what I mean about energy and cost being connected. In particular, if I spend more money on more expensive panels, or more expensive, or if we've got trackers, for example. Let's use that as an example. If I'm building a solar farm and I decide to add trackers that track the sun through the day, that should do two things. One, it should increase our availability, it should increase our ability to operate closer to capacity. So for the same resource, we can actually get more out of it, particularly in the mornings and the afternoon. So on the one hand, that should increase the amount of energy that we generate for the same capacity. Now, what it does then from the cost point of view could vary. It might cost us more to build, so our cost of capacity might be higher. It also might introduce a bit more risk in terms of availability. There's more to break. We've introduced some moving parts, so maybe the trackers go wrong every now and again, and the motors have to be replaced. So we might reduce some of our, we might increase some of our energy generation, but we might introduce some more risk in terms of our availability. Even if we don't have trackers, just think about, again, and we'll think about solar, if we just got fixed panels. One reason why we may operate below capacity or not operate at all more frequently is if we spend less money on operations and maintenance. So if we clean the panels less often, it will save us some money, but we'll end up over here a bit more often. If we're really lax, we might even get breakdowns that we don't pick up. To flip that around, an alternative strategy might be to spend more money up front on installing some fancy SCADA system and monitoring data gathering systems all across the project, having power conditioners and micro inverters and so on, a whole bunch of other stuff to kind of be able to monitor our plant more efficiently and maybe able to preempt breakdowns and so on. That might reduce our losses in terms of plant availability and again increase our energy generation, but there will be a cost to doing that. So again, when we come to what we'll do next is we'll kind of then say, well, having seen that some of these things are interrelated, these risk factors are interrelated on cost and on energy, then we can start to play around with what impact that might have on a financial model. So let's flick to that now. Let's flick away from the PowerPoint briefly. So I just want to, again, very briefly illustrate that. This model, we're going to use only a fraction of this. It's basically a financial model for a power project. And I mean, there's gazillions of inputs low down, but we're just going to play around with a few at the top just to make some very simple points in the time available. So I've set up a base case here. So I've got a 50 megawatt project. I'm going to analyze it over 20 years. It's let's say it's a solar project in a very sunny spot, so with a capacity factor of 27%. So it's going to be produced, that's going to define how much energy we produce. And I've got some assumptions in about degradation and so on. The other thing we've talked about is cost. So I'm saying, okay, it's going to cost me $1,000 per kilowatt, $1 a watt to have that completely installed. So overnight installed cost is all my costs, development, construction, all in. That's how much it costs to have that power plant sitting there on the ground. And then I've got some fixed operations and maintenance costs, which I'm saying are $10 per kilowatt. Don't worry for the moment if these assumptions don't match your perfect numbers, for two reasons. One, numbers vary for different projects, vary in quite large amounts in different parts of the world, and really we're just trying to illustrate a point here. So I'm going to play around with some of those features, and my aim is to produce an acceptable return, and we'll come back to what we mean by an acceptable return, given a particular price. So I'm assuming here I'm going to sign a PPA or I'm going to win a feed-in tariff agreement. I've basically winning some contract that gives me a guaranteed price for 20 years, in this case of $44 per megawatt hour, so 4 cents per kilowatt hour. And I've also got some assumptions on how I'm financing that. So in this case, I'm financing it 25% out of my own pocket, coming at it from an equity investor point of view, which means that the other 75% is coming from debt, coming from the bank. And that debt, I'm going to assume an interest rate of 6%, which I can pay back over the full analysis period of my project over 20 years. Okay, now with that set of assumptions, so with a set of assumptions and a price of $44 per megawatt hour, the other number to look at is up here. As an equity investor, I'm making a return of 15% on this project. So that sounds fantastic. It may sound fantastic. Again, we'll come back to that, but it depends very much on who you are and where you are. Now, obviously, from a risk point of view, the thing that we need to do with our financial model is not assume it's right, but is to use it as a kind of basis from which to start playing with variables. And so we've picked out a few key variables. One obviously key one is how much energy we're going to generate. And so, for example, we can look very simply at what happens if I choose to play around with capacity factor. So say I'm wrong on capacity factor. Say my capacity factor is out by 10%. So 10% of 27% is 2.7%. So if I now have a capacity factor of 24.3%, that would represent a 10% reduction in my capacity factor. What effect is that going to have on my returns as an equity investor? I'm not worried about the returns of the bank because they're getting 6%. Their returns are fixed by the interest rate. Okay, now that doesn't look terribly good. Now, the reason I'd chosen 15% is presumably because that was what my equity investors required before they'll even invest in my project. So what I really want to know here is not the effect it's had on my equity returns. What I want to know is what impact it's going to have on the price I can bid to still keep my equity investors happy. And so if I play around with some numbers, I can start fiddling with this. It's going to have to go higher than that. Higher still. So I'm going to have to bump the price up by about $5 per megawatt hour, just because I'm 10% out on my energy estimate, and that's a pretty significant chunk. In effect, so 5 on 44, it's pretty much a 1-to-1. If I'm 10% out on my energy, I'm going to have to bump my price up by getting on for 10% as well. So that's obviously quite a significant impact. If I go back to where I was before, I can then think about risks on cost. So on cost, let's assume I'm in error by 10%, my cost would now be $1,100 per kilowatt. Again, I'm below the 15% that I started, so I'm assuming that 15% was what investors had that was their target before they'd give me the money in the first place. So again, I have to look at what impact that's had on my price. So you get the picture. We'd play around with the numbers until we're back up to our required target return on equity. So in both those cases, if we're wrong, there's a risk. Cost is obviously a big risk, capital cost is obviously a big risk, and energy reduction is obviously a big risk. If we've overestimated our energy production, or if we've underestimated our cost, then either we're going to have some very unhappy equity investors, or we're going to have to bid quite significantly higher in our auction, and then the risk obviously there is that we don't get into the system in the first place because someone else who's got their numbers right wins that auction. Okay. Now, what we'd think about there, of course, is maybe it's worth spending a bit more. Maybe it's worth spending a little bit more on equipment if actually, because I'm using trackers, for example, maybe I get a bigger energy output. Now they've kind of roughly balanced each other out. If that's the outcome, I can reduce my price a little bit because I to get that down to 15% to meet my expectations. But that's the kind of risk reward calculation we could play around with from a financial point of view. Now, what about operations and maintenance? Now, one character of renewable power projects, particularly solar and wind, is that they're very much dominated by capital cost rather than operating cost. And so actually here, if I take my O&M, I'm actually going to say, well, what if I'm out by 25%? What if my ongoing O&M costs cost me 25% more than I've thought they were going to, so 12.5. 25% increase has actually made a relatively small difference in my returns. So, I mean, to compensate for that, I could, if I thought that was going to be the case, I could up my price a little bit. But in this case, it's not catastrophe for your equity investors. And really the point there is that increasing your O&M by quite a large amount is actually having a relatively small impact on your financial risk. And bear in mind that if we spend 25% more on our O&M, even if it only raises our capacity factor by a fraction, another %, we've more than recovered that risk. So again, one thing you've found, I think, over time with renewable power projects, it's happened first with wind and it's starting to happen now, I think, with solar as well, is that project operators have realized that actually there's a point at which cutting costs on O&M is not a great idea from a project and a financial risk point of view. In fact, spending a bit more on O&M can actually produce a better outcome, as long as obviously what you spend, because you can spend substantially more, relatively speaking, on O&M, and it only has to raise your energy output by a relatively small percentage, but the impact of that is so much greater on the overall economics of the project. And so, if I nip back to the PowerPoint, you can do that kind of sensitivity analysis and plot these kind of diagrams. So what this is showing is that I've got a base case here. And so, for example, if I take the capacity factor curve, what that's saying is that if I increase my capacity factor by 10%, then I can reduce my bid price to 40. And so I'm becoming more competitive. The other two, obviously CapEx, if I increase my CapEx by 10%, then I'd have to increase my bid price. If I introduce my O&M though, I can increase that by quite a lot and have a relatively small impact on the price that I have to bid. So in other words, if you start plotting a diagram like this, steeper lines are showing you the factors, the variables, which your project is much more sensitive to. There's a much bigger risk to your project should your assumptions start to change. And again, you could plot this if you didn't want to think about this in terms of bid price, but you wanted to think about it in terms of return on investment. You could do the same sort of diagram, but plot rate of return on the y-axis instead. But it's telling you that, again, just from a very simple analysis, that for projects like solar and like wind, where they're very much dominated by capital cost, the O&M obviously you want to keep it, you don't want to spend more than you have to, but there can be a situation whereby if you spend a little bit more on O&M, it's not going to have an enormous impact on your competitiveness, and in fact, if the result of spending more on O&M is that you then also get an increase in capacity factor, actually it could increase your competitiveness. So although we talk about these variables for risk, bear in mind that they're not exclusive, they're not all independent of each other, and so it's understanding how they connect together is going to be important as well. Okay, and that kind of that issue around kind of upfront cost versus ongoing costs also brings us to another kind of final bit that I'll briefly mention, which is the cost of money. Now, we've kind of already talked a little bit about that, because by cost of money, what we're effectively saying is, well, this capex to get this money in the first place, how much do we have to pay out to raise that money? And that's determined by, on a simplistic basis, if we think about it in terms of a simple debt equity situation, we pay the bank an amount of interest, so the bank gets a return on lending us money, which is it's a kind of fixed return set by the interest rate. I mean, there can be other debt financing structures that might make it a bit more variable, but taking it from a simple level, we tend to think about debt as a relatively fixed, known return for the bank, and then our equity investors get paid. They may get paid by selling the project eventually, but the cash flow that provides that return either directly or through the value into the sale is the dividends that we can pay them. So how much cash have we got left over each period after we've paid for all these other bits and pieces? And so that, because this upfront cost is the biggest chunk of the project, and we've seen that our returns and our competitiveness is very sensitive to that upfront cost, it's no surprise that it's also very sensitive to the cost of raising that money in the first place. So our financing costs are also extremely important. And so again, we've not got a huge amount of time, but what you do is you can very briefly illustrate that by going back to our analysis. So I've gone back to our base case. So now I'm not going to change anything about energy and installed cost and operating cost. I'm going to assume I've got all those exactly right. But one thing that can vary dramatically between different countries and different regions, and again this goes back to kind of external risks, because it'll be around things like the business environment, policy certainty, and a whole bunch of other factors, and the macroeconomic environment, is the cost of money. So let's run this same project, the same energy generation, the same costs, the same size, but I'm just going to make money easier and cheaper to get. I'm going to say, well, I'm going to have an interest rate of, say, 3%. Okay, and I'm going to say, well, actually, if the debt rate is 3%, my equity investors are quite happy. They're aiming at a target return of 10%. Oops, that's a bit optimistic. So now the mechanics of the project are exactly the same. It's costing me the same to build. It's producing the same amount of energy for the same amount of time, degrading at the same rate. The only thing I've changed is how expensive, in this case how cheap it was for me to get that money in the first place. And in doing that, I've suddenly reduced my energy price that I can bid from $44 per megawatt hour down to less than $33 per megawatt hour. So an enormous difference in price. And actually, if you look around the world at these markets where we have seen insanely low solar prices in particular, and also we're seeing some insanely low wind prices, when you look into those projects, that's not being achieved purely by the reduction in cost of technology or amazing increase increases in availability of resource or capacity factor to turn that resource into energy. A big driver for cost reductions recently has been the availability of cheaper finance and being able to raise that capital cost in the first place more cheaply, both in terms of the interest on debt, but in particular the amount that equity investors are prepared to do that for. And actually you can again do the same thing. If I go back to my PowerPoint, I can add those financial factors, the cost of money, onto my sensitivity diagram. And what you'll find in the particular case I've modelled here is that equity in the purple is actually quite a steep line. So what that's saying is that if my cost of equity goes up by 10%, and that's 10% of whatever it was, so that's saying if I went from expecting 10% return to 11% return, then the cost of the cost of energy in effect goes up quite steeply. On the other hand, interest, the debt rate is slightly less, slightly lower impact, and that's obviously because the cost of debt we're assuming is less than the cost of equity. But what's interesting again in this case compared to my base case conditions is that actually the O&M has a much, changing the amount I spend on O&M has a much lower impact than either of those, than changing the interest rate and certainly changing the rate of return that's expected from our equity investors. So if you want to be more competitive and the risk of being less competitive, if you want to be more competitive, it's kind of obvious to say that you want a higher capacity factor. You want to be able to, a higher capacity factor will be good, and everything else you want to be lower. You want lower capex. You want investors that have a lower return expectations. You want a lower interest rate from the bank, and you want to spend a bit less on O&M. And so your risk is, if you've gone the wrong way on those, is that either you're less competitive on price, or your investors are going to be a bit disappointed, particularly the equity ones, because their returns will go down. Okay, and then obviously the expectations on return are very much linked back to perceptions of risk. So if we did want to spend more money up front by having some fancy new tracking system, that might actually be an issue in trying to raise debt, because generally debt investors, they've got a fixed return, they're getting their 6% plus an arrangement fee, and they're getting a lot less return than our equity investors are expecting, which means they've got a fairly low appetite for risk. Their question is probably going to be, well, show me another 10 projects that have been using these trackers and give me lots of data on how often they have or haven't gone wrong. And you may not be able to do that, so you may not be able to raise debt, or you may not be able to raise as much debt, or they may charge you more for it. They might charge you a higher interest rate, or expect that money to be paid back over a shorter period of time. So that's on the one hand. There's also some administrative burden, a lot more due diligence potentially to do with raising debt. On the other side, your equity investors, they have a downside if, as we said, your risks turn out to be true, but they've got an upside. So if you can operate your project more efficiently over time and generate more money, increase the availability, capture more resource, whatever the reason may be, or refinance later on at a lower debt rate, for example, they've got the opportunity to make a bit more money. Hence, they're taking more risk, so they'll expect a bit more return. But it's going to be very varied. It very much depends on who your investors are and what their objectives are as to what those risks, their risk appetite is, and hence what their expectations are going to be. And that's a whole other subject in itself. In some cases, again, with these very, very low prices that you see around the world, if you look at some of those projects, you'll often find that equity investors the big equity investor will be the company that's supplying the panels for the project, or the EPC contractor for the project, whatever. Now, in many cases, they've got a strong reason why they're not going to expect enormous returns if they're doing it as a strategic play. They want to build market share. They want a high profile project that they've provided equipment for. They want to prove that their equipment works in certain environments or on a big scale, whatever the reason may be. So there can be reasons why, although we think of debt as being cheap and equity as being more expensive, you might have situations where there are strategic investments that make equity cheaper as well. And then, again, we've kind of not got time to cover this in any detail, but as well as the percentages I'm putting on those, which I stuck into the spreadsheet, the other thing I can change, the other thing that matters between the two, is the split between the two of them. So if, for example, let's raise this up a bit. Let's say I can be competitive at 35. If I can raise more debt, so if I can, instead of putting in 25% of the money myself, I only have to put in 20% of the money myself, you'll see that from, instead of making 12% on my equity, I can make another % on my equity. So I mean, that's leverage. So if we can leverage more debt and put in less of our equity, then our returns on that equity will go up. Again, that's a topic for another day. But that leverage, as well as the cost of money, the structure also is linked into some of the things we've talked about. For example, one mechanism or one metric that lenders might use to size a loan would be what's called debt service coverage ratio. Now, that's measuring how much cash you've got available at the end of each period to pay what you need to pay to service the debt, so repayments and interest or whatever the mechanism excuse me, in place is. And we know, obviously, that the amount of cash flow we have available is dependent on how much energy we generate, the costs we have to pay to generate that energy, and the price that we can sell it for. While the size of our debt is dependent on the interest rate, how long we've got to pay it back, and the amount we've lent in the first place. So again, these risks kind of are connected together, because we know, for example, that on our energy, if we have uncertainty around energy, we've got a higher risk around the amount of energy we're going to generate, then it means we have a higher risk and a higher uncertainty around the amount of cash we're going to generate. And if we have higher uncertainty about the amount of cash we're going to generate, and our lender is going to base the size of our debt on being able to meet a certain ratio between these two, if we reduce the top line, we're going to have to reduce the bottom line. And your lender is not going to reduce it by saying, oh, well, fine, pay less interest or pay it back more slowly. They're going to reduce it by lending you less money. So again, we often think about risk to energy generation about producing too little. There's also, this is just making the point that there's also a risk around predicting too little, because what we're talking about here to arrange your loan size in the first place is giving the bank a nice, reliable, low-risk estimate of what your minimum amount of energy generation is going to be, what we call the P90, energy figure. And if you underestimate that, because you've got quite uncertainty around it, and they'll be quite conservative if there's uncertainty, then if you underestimate your amount of energy, you'll end up with a smaller loan, as we saw on the sheet very briefly. If you've got a smaller loan, you have to put in more equity, and so your return on equity will be less. And a lesson out of that, again, it comes back to spending money, is that if you spend more money on resource assessment in the first place during that development phase, then a positive outcome of that is that by spending more money on resource assessment, you have more certainty on your amount of energy, and you can end up with a larger loan. And if you end up with a larger loan, you can make more money on the equity that you put in. So it's those kind of connections and understanding those kind of connections that become very important. On the one hand, sticking up met masts to measure the wind for a year seems far away from your return on equity calculation on a financial spreadsheet, but actually the two are directly related, because the better your resource assessment work, and spending a bit more money up front on resource assessment can have a direct impact on the amount of money you make as an equity investor, because it can affect the structuring of your project. Okay, I'm aware I've, as usual, filled up my time a little bit. So that was a bit brief, but it just to give you a flavour of some of the connections between the different risk categories that we're looking at. And so I'll kind of sum up. There, the title was kind of quite grand, key variables. I mean, there are lots of variables. Hopefully one of the things I've impressed on you is that although ultimately we end up sticking things on a spreadsheet to work out our financial case, what feeds into that, and the variables that feed into that, and also the variables beyond that, there are many and varied. There are some that are internal that you could have control over. There will be some that you will always have to accept you don't have control over, and then particularly going forwards, risks around policy, regulatory change, business change, and so on. You also need to think about risk in terms of time frame, so where we are in our different risks at different phases of the project, how long those phases take, because obviously if something takes longer, you've got a bigger risk that while you're getting on with it, those external risk factors have changed. So if it takes you ages to develop a project, then you may have started out in one regulatory environment, and by the time you come to be in a position to finance it and build it, you might find the rules have changed, which they may have changed in your favour, but they may have changed against you. Again, when you think about risk, it's always worth thinking about opportunity at the same time. And then I briefly introduced the idea of looking at financial sensitivity. When you do a financial model, we call it a base case for a reason. It's one case. It might be your best guess, but it's not the answer. The first thing you do when you've got a financial model set up is you start playing with it. You start changing the variables, and you'll find that some of them matter a great deal, and others matter a lot less than you thought of. And then also what you need to think about is how they connect together. If you change one thing, it may look like a negative change. It may look so, why am I spending more money on that? But then if the knock-on effect is to massively reduce risk from another factor, such as the amount of energy you generate, then it may be worth doing. But it's not, but without playing around and doing sensitivity analysis on those variables, you can't really come to those conclusions. So we've kind of just scratched the surface a bit there, but hopefully it's given you a kind of sense of how to start thinking about some of these things, and in particular the kind of broad range of categorizing areas of risk, from kind of market risk to project risk at different timescales, down to then analysing specific financial outcomes and financial risk factors.